Over the past month or two, we saw the first clear sign of the housing market changing. This was when companies like Better.com started to lay off workers as mortgage demand just started to plummet. Mortgage rates went from 3% earlier in the year to now 5%, even touching 6%. And this has caused people just to drop out of the market completely. And now we're seeing a doubling down of this effect. Companies outside of just the lending business are starting to slash workers as well. We're seeing layoffs now in brokerages and also in iBuyers, or big corporations that are purchasing homes and flipping them for profits. And now we're past the turning point in the housing market. It has definitely flipped from being red hot as it was earlier this year and last year to now where things are really starting to cool down, and we're starting to see signs of that all across the industry. Now, it takes a lot of time for all the data in the real estate market to start flowing through so that we can really see the trends impacting the market. With the stock market, everything happens so immediately and instantly. Same with crypto. You know whether the market's booming or busting or crashing on the same exact day. But with the real estate market, things are a little bit delayed, but there's a lag in the data, and it's finally starting to catch up to us now that we're seeing the clear signs of the impact of the rate increase 3 or 4 months ago to what's happening in the market today. And what these leading indicators for the market are showing is that this crazy increase we've seen over the last 2 years, 30% appreciation in house prices, has turned a corner and is starting to decline. And we're definitely going to see this affect certain markets heavier than it's going to affect others. And definitely don't forget to stick around to the end of the video because I have a great map that I'm going to show you which real estate markets are really being impacted the most right now. All right, great. So before we dive in, please don't forget to smash the like button on this video. Hit subscribe if you haven't already so that you can stay tuned in to any updates on real estate, business, and finance from my channel. And let's jump into the video. So let's take a look at this first article from CNBC. So real estate firms Compass and Redfin announced layoffs as the housing market slows. In filings with the SEC, Compass announced a 10% cut to its workforce, and Redfin announced an 8% cut. Shares of both companies fell Tuesday, and Redfin stock touched a new 52-week low. Rising rates and overheated home prices, which are now up over 20% from a year ago, according to various surveys, have crushed affordability. Home sales have been dropping for several straight months, and the fall is expected to worsen. Mortgage demand has fallen to its lowest level in over 2 decades. Rates have taken off since the start of this year, rising from 3.29 in early January to 6.28% now. And rates have shot up more than half a percentage point in just the past 3 days as concerns over inflation hit the bond market. Due to clear signals of slowing economic growth, we've taken a number of measures to safeguard our business and reduce costs, include pausing expansion efforts and the difficult decision to reduce the size of our employee team by approximately 10%. Now, honestly, guys, I think this is probably just the beginning of the layoffs we're going to see in this industry. So first we saw it hitting banks and lenders, which honestly we're probably going to see more of that. But now companies like Redfin, we probably see Zillow, Opendoor, all these other major companies, probably even builders as well. We're going to start to see all these effects flow through the market as demand for housing and real estate starts to come down from where it was a year ago. And the reason for this is a lot of these companies hired aggressively during the last year. They saw massive growth and they weren't able to capture all of this potential growth and revenue that was out there without expanding their teams. But they just didn't have really the foresight to know what the Fed was going to do to rates and how that was going to impact the economy and the real estate business as a whole. Now, continuing in the last 2 paragraphs here, which I think are really great, the Redfin filing had an attachment from CEO Glenn Kelman, who writes a regular blog on the company's website. In the blog posted Tuesday, Kelman wrote, "With May demand 17% below expectations, we don't have enough work for our agents and support staff, and fewer sales leaves us with less money for our headquarters projects." Kelman went on to say that with mortgage rates increasing faster than at any point in history, we could be facing years, not months, of fewer home sales, and Redfin still plans to thrive. If falling from $97 per share to $8 doesn't put a company through heck, I don't know what does. So demand is just massively fallen off a cliff for some of these companies. And again, I don't think Redfin's going to be the first one to experience such a shock. Now, this next article from Business Insider says the US housing market is seeing its worst contraction since 2006 as mortgage applications crumble, says Freddie Mac economists. Remember, 2006 was even before the housing market crisis of 2008 and 2009. So really, things are not in a good position right now. Now, jumping into this article has some really great gems, so I want to highlight those to you guys. An already punctured US housing market is set to deteriorate to levels witnessed in 2006, a Freddie Mac economist tweeted Thursday. The The U.S. housing market is at the beginning stages of the most significant contraction in activity since 2006. It hasn't shown up in many data series yet, but mortgage applications are pointing to a large decline over the summer. Purchase apps down 40% from seasonally adjusted peak. So just as a reminder, the housing market is extremely seasonal, with peak demand coming in the summer and then that really starting to fall off in late summer, early fall, and it doesn't really start picking up until about May or June. So this is huge. It's saying that purchase apps are already down 40% from a seasonally adjusted peak. I mean, this is the time when the housing market should be starting to come out of the winter slumber and really lighting on fire. And we're actually seeing the opposite right now. So really, really impactful. And then the article continues here. The National Association of Realtors has said housing affordability tumbled a record 29% over the last year, the steepest annual decline on record as mortgage rates and housing prices shoot upwards. So it's really this combination, right? Rates skyrocketing, but then also home prices skyrocketing. So both of those combined have just totally wiped out purchasing power for the average consumer. One economist even said US mortgage applications are in meltdown as borrowing costs soar. In the week leading up to June, the MBA said that applications for new purchases fell at 52% annualized rate compared to the previous 3 months. And again, remember, this mortgage purchases are a leading indicator. So when somebody applies for a mortgage, it's usually 2-3 months, really at minimum, before they're actually going to close on that home and finalize that purchase. So it's a big leading indicator. So if right now at the start of the peak season, we're seeing mortgage applications decline significantly, I mean, that just means demand has really fallen off a cliff, and we're going to see probably a lot more supply come onto the market during the summer. A meltdown, in other words, Pantheon Macroeconomics chief economist Ian Shepherdson said. A separate survey echoed gloomy buyer sentiment and recorded that about 80% of respondents say it's never been a worse time to buy a home. Consumers' expectations that their personal financial situations will worsen over the next year reached an all-time high in the May survey, and they expressed greater concern about job security. So people are just worried about the recession. So it's demand is really starting to decline. So while we're seeing demand starting to come down, and again, these leading indicators, these early indicators that we're going to see further declines in demand, we haven't quite yet seen the rebound in supply that we need to really see home prices come down at a significant rate. So that's really, I think, the big missing piece of the puzzle here. All right, and as I mentioned in the beginning of the video, I wanted to show you guys a couple of great infographics that show where inventory levels are starting to rise. Again, it's still very early stages in this shift in the housing market, but what we're seeing here is there's a couple of markets that are really starting to have inventory increases. So first, it's important to understand what this map is showing. So this is the change in inventory levels from March 26th, 2022 to May 7th, 2022. So about a month and a half period here. So anything in blue, dark blue, means it's increased, inventory has increased by about 50%. And then anything neutral is about 0, and red is we've seen inventory decreases. So really you want to focus on the dark blue areas because that's where inventory has increased the most. So we're seeing areas here like Northern Idaho and Spokane, Bend, Reno, and Flagstaff. We're seeing a little bit of activity here in Utah, Salt Lake at 40%. A little pocket here in the Northeast also, which is interesting to me because we didn't really see massive increases in values there, or at least not as much as some of these other areas. And also some other metros along Florida like Destin, Naples down here, and Austin as well. So, and then of course, you know, all over here in California. So some of this is normal because again, seasonality, most people tend to move in the summer, and so they're starting to list their homes in the summer. But again, I think we're seeing this impact different areas differently, and that's because some of these housing markets obviously were more overvalued than others. And so those are the ones that are being impacted the most because as consumers can't afford those crazy prices with rates going up, more of that inventory is sticking around for longer. But it's also really important not to just understand how inventory has changed over the last couple months, but how this has changed over the past 3 years. And this chart shows exactly that. So you can see here the scale here is the same, but the time period is from May of 2019 versus May of 2022. You can see pretty much every market here is dark red, which means inventory is just still down from pre-pandemic levels. So while yes, we're seeing inventories start to shoot up by 50% in some areas, we're still not anywhere close on a national level to where we were before the pandemic. And I think that's really what we need to get back to see prices really start to drop and fall off a cliff. So I think it's still a little early to determine if that's going to happen this summer or this fall, or if it's going to take a couple of years. But obviously I've shown you in this video that demand has really started to fall, but it takes a little while for supply to start to creep back up to levels, I guess, more normal levels. All right, guys, thank you so much for watching. I really hope you found all the data and information that I covered today useful as you're thinking about what's happening in the real estate market. So please don't forget to like the video and subscribe to my channel so I can keep bringing you content just like this to keep you up to date on what's happening in the real estate market. All right, thank you guys, and I will see you in the next one.